There is a particular kind of danger that never announces itself. It doesn't crash through the front door. It doesn't show up as a red screen on the news or a number falling off a cliff. It arrives quietly, in the background, disguised as normal life. And by the time most people recognize it, the damage is already behind them, not ahead of them. That is the exact kind of risk we're living inside right now. And the strangest part is not that it's hidden. The strangest part is that one of the most respected investors of the last half-century has been describing it out loud, in plain language, for years, and most people still manage to look right past it. His name is Ray Dalio. He built the largest hedge fund in the world by studying something most investors find boring until it's too late. Not individual stocks, not hot trades, but the deep machinery underneath the entire system. How debt builds, how it unwinds, and how empires quietly lose their footing while everyone is still cheering the scoreboard. And his warning today is not that a recession is coming in the ordinary sense. His warning is subtler and, honestly, more uncomfortable than that. He is telling us that the risk most investors are ignoring is not a sudden collapse at all. It's a slow, self-reinforcing process that has, in his words, already crossed a line past which the usual tools stop working. So the real question isn't, is a recession coming? Everyone argues about that. The question that actually matters is the one almost nobody is asking. What happens when the problem isn't a downturn you can wait out, but a structural condition you have to live through? And more importantly, what does that mean for the money sitting in your account right now? The plan you've built for retirement? The assumption that if you just work hard and save, the ground beneath you will stay solid. To understand why this risk hides so well, you have to start with the thing that makes it invisible. On the surface, everything can look fine. Markets can be near record highs. Unemployment can be low. The economy can feel day-to-day stable enough. And that surface is real. It's not a trick. But Dalio's entire framework is built on a single unsettling idea. The surface and the foundation are not the same thing, and they don't move at the same speed. You can have a strong-looking economy sitting on top of a weakening structure. The same way a building can look pristine years before anyone notices the cracks in what's holding it up. The danger isn't the paint. It's the load-bearing wall you can't see. And the load-bearing wall Dalio keeps pointing at is debt. Not just debt as a big, scary number, though the numbers are staggering. The U.S. national debt now sits above $36 trillion, and the federal government spends close to $1 trillion a year just paying interest on it. That's not paying it down. That's just the rent on money already borrowed. But the number itself isn't the point Dalio is making. The point is the behavior of the number, the way it starts to move once it gets large enough. Here is the mechanism. And this is the part the headlines almost always skip. When a government owes a great deal, it has to keep borrowing to cover the interest on what it already owes. It borrows to pay the debt, and that new borrowing creates more debt, which creates more interest, which requires more borrowing. Dalio has a name for the stage where this starts feeding on itself. He calls it a debt-death spiral, the point where a borrower has to take on new debt simply to service the old debt, and the whole thing accelerates. And he uses an image that's hard to forget once you hear it. He compares it to plaque building up in the arteries of a body, slowly squeezing the flow of blood until the system can't move the way it's supposed to. It isn't a heart attack in a single dramatic moment. It's the years of narrowing that make the heart attack possible. Now here's where it stops being abstract, because your instinct might be to say, okay, that's the government's problem, not mine. But that's exactly the assumption that makes this risk so easy to ignore. The way this problem gets resolved is precisely how it reaches into your life. Because there are really only a few ways out of a debt this large, and each of them lands on ordinary people in a different way. The first way out is default, simply not paying. But Dalio is clear that this almost certainly won't happen, and understanding why is the key to the whole thing. A country that borrows in its own currency doesn't have to default. Because it has another option. The rest of us don't. It can create more of that currency. The central bank can step in, print the money, and buy the debt. And when Dalio describes this, he doesn't soften it. He says, in effect, there won't be a default. The central bank will come in and will print the money and buy it. And that is where the depreciation of money happens. That last phrase is the entire warning compressed into 4 words. The depreciation of money. The debt doesn't disappear. the value of your dollars quietly does. This is the layer that changes everything, and it's the layer the doom headlines rarely explain properly. The risk here isn't that you'll wake up one morning and your bank account will show zero. It's far quieter than that. The number in your account can stay exactly the same, while the value of that number slowly erodes underneath you. You still have your dollars. They just buy less. And you feel it not as a crash, but as a grind. Groceries that cost more, rent that keeps climbing, a paycheck that somehow covers less than it did a couple of years ago, savings that technically grew but somehow don't stretch as far. We already lived through a preview of this. When inflation surged a few years back to a level not seen in 4 decades, that wasn't an accident falling from the sky. That was, in part, the aftershock of exactly this kind of money creation. And the cost of the essentials, food, housing, never fully came back down. So think about what that means for the specific things you're counting on. Think about a retirement account. You spend 30 or 40 years faithfully saving, watching the balance grow, doing everything right. The whole plan rests on a silent assumption that the dollars you save today will hold roughly the same value when you finally need them. But if the resolution to a debt crisis is a slow depreciation of the currency itself, then that assumption is the very thing under attack. You could reach the end of your working life with the exact number you planned for and discover that the number means less than you were promised it would. That's not a market crash you can see and react to. That's a redefinition of the finish line while you're still running toward it. And this is where Dalio makes a distinction that separates real understanding from surface panic, one the competitor content on this topic almost never reaches. He points out something so obvious it's almost invisible: you cannot spend wealth. You can only spend money. To actually use your wealth, the house, the portfolio, the retirement account, you first have to convert it into cash. You have to sell it, and the crisis, in his framework, isn't the moment prices are high. It's the moment when a lot of people are forced to sell at once, to cover debts, to meet obligations, to raise cash they suddenly need. That's the moment the paper wealth on the screen has to become real, and discovers it isn't worth what everyone assumed. The bubble doesn't pop when it's inflating. It pops when people reach for the cash they thought was there. Which raises the next question. If this pressure's building underneath the surface, is there any way to see it before it breaks through? And here's the part that should genuinely get your attention. Dalio says the early signals are already flashing, and they're showing up in a market most ordinary people never watch. Not the stock market, the bond market. The bond market is where the world lends money to governments, and it's usually calm, quiet, and boring, which is exactly why it's the honest one. When it starts to behave strangely, it's telling you something the excited stock market won't. Dalio points to a specific pattern: long-term interest rates rising relative to short-term ones, a weakening dollar, and money quietly rotating out of traditional assets and into gold and alternatives. In his reading, those aren't random. Those are the fingerprints of a system beginning to doubt whether holding all that debt is still worth it. Because as he puts it, one man's debt is another man's asset. And the moment lenders stop believing they'll get a real return, the whole arrangement starts to strain. And notice what that does. Rising long-term rates don't stay contained in the bond market. They feed directly into everything else. They put pressure on stocks because suddenly safer bonds are competing for your money. They raise the cost of mortgages and car loans and business borrowing. They squeeze the government even harder because now its own debt costs more to service, which loops us right back to the beginning of the spiral, tighter than before. This is why Dalio calls it self-reinforcing. Each part makes the others worse. It's not a single problem. It's a system quietly turning against itself. Now here's the twist that lifts this from an economics lesson into something that should genuinely change how you think, because this is the layer most people never get to. The reason this risk is so easy to ignore isn't just that it's slow. It's that it's arriving at the exact same time as something that looks like the opposite of a crisis. We are living through a technology boom. There is enormous excitement, enormous investment, a genuine sense that the future is being built right now. And Dalio doesn't dismiss any of that. He agrees the technology is real and transformative. But he also warns that every great technological revolution in history has produced a bubble, because the promise of a technology and the price of the stocks attached to it are two completely different things. Buying the stock is not the same as owning the future. You can be completely right about where the world is heading and still overpay so badly that you lose money on the way there. Sit with why that's so dangerous. It means the optimism itself is part of the trap. The excitement about the future can pull attention away from the arithmetic underneath. Everyone is looking up at what's being built while the foundation is quietly narrowing. Dalio has said the market is approaching levels of froth he compares to some of the most famous bubble tops of the last 100 years, not to predict a specific date, but to point out that concentration, valuation, and euphoria are lining up in a familiar and uncomfortable pattern. And bubbles, he's careful to note, don't burst when they form. They burst later, when someone finally has to sell. And there's one more layer, wider than all of it, that most investors treat as background noise when it may be the loudest signal of all. Dalio's framework has never been only about money. It's about the rise and fall of the whole order that money sits inside. He spent recent years warning that the global order we've all quietly assumed would last, the one where the U.S. sits comfortably at the center, where the dollar is unquestioned, where the rules feel fixed, is not fixed at all. He describes a world drifting toward what he calls a capital war, where money itself becomes a weapon between nations, where you put your assets becomes an act of strategy rather than just investment. He points to flashpoints where a single decision by a rival power could send shockwaves through global markets almost overnight. You don't have to accept every detail of that vision to feel the weight of the underlying point. The stable backdrop we've all been planning our lives against may be far less permanent than it feels. So step back and look at what's actually being described here. Because when you assemble the layers, the picture is different from the one the headlines paint. The risk investors keep ignoring isn't a single dramatic event you can brace for. It's a convergence, a debt structure that's begun feeding on itself, a resolution that quietly erodes the value of money rather than defaulting on it, a market pushed toward euphoria by a genuine technological revolution, and a global order that's less stable underneath than it appears. Each one alone is manageable. Together, arriving slowly and at the same time, they form the kind of risk that's almost designed to be underestimated, because none of it looks like the crisis we were all taught to watch for. And this is the part I want to be honest with you about, because it's where a lot of finance content goes off the rails. Nobody can tell you the exact day something breaks, or whether it breaks loudly or just keeps grinding for years. Dalio himself is careful about that. He talks in terms of pressures, cycles, and probabilities, not precise predictions. And anyone who promises you a specific date and a guaranteed outcome is selling you certainty that doesn't exist. This isn't about panic. Panic is just the mirror image of ignoring it. Both are ways of not thinking clearly. The point isn't to be afraid. The point is to stop assuming the ground is as solid as it looks, and to start seeing the structure underneath the surface. Because here's the quiet truth underneath all of it. The people who tend to come through periods like this aren't the ones who predicted the exact moment. They're the ones who understood the mechanism early enough to think clearly while everyone else was still reacting to headlines. They understood that money and wealth aren't the same thing. They understood that a strong-looking surface can sit on a weakening foundation. They understood that when a system starts creating money to solve its problems, the cost doesn't disappear. It just gets spread quietly across everyone holding that money. And that understanding, more than any single trade, is what let them protect what they'd built. That's really what Dalio has been trying to hand people this entire time. Not a stock tip, not a doomsday date. A way of seeing, a framework for reading the machine instead of just watching the scoreboard. And the reason so many still look past it isn't that it's too complicated. It's that it asks something uncomfortable. It asks you to take the boring, invisible things seriously before it becomes the loud, obvious thing. Most people can't. By the time the risk is undeniable, the moment to think clearly about it has usually already passed. You've just done the harder thing. You sat through the part most people skip, the mechanism, not just the scare. And if this way of looking at the world resonated with you, understand that this is exactly the kind of thinking that has to be practiced, not watched once. The forces we walk through today don't resolve in a single video. They keep unfolding month after month in the bond market, in the debt numbers, in the value of the dollar in your pocket, and being able to read those signals as they move is a skill worth building. So, if you want to keep sharpening it, subscribe and stay with this channel, because we break down these deeper mechanisms, the ones the headlines rush past, one careful piece at a time. And I'd genuinely like to hear from you. After everything we covered, what's the risk you think most people around you are still ignoring? Leave it in the comments, because the conversation in that section is often where the sharpest thinking happens. Stay curious, stay clear-eyed, and keep watching the foundation, not just the paint.